Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and I'm here to give you a brief market update. Today is Monday, March 16th, and we just witnessed one of the more brutal trading sessions that the S&P, the NASDAQ, and the Dow have ever seen. Certainly since 1987, we haven't seen drops this large. It's important to put it all in context. The indices are down about 12% today, plus or minus, depending on which index you're looking at. However, we were up about 9.5% to 10% on Friday. So once again, we're giving back a little bit of the gains that we got late last week, plus a little bit more. In terms of an absolute level for most of the indices, my own particular favorite is the S&P 500. We're at about 2380 for the S&P 500 versus the 2500 level that we really held on to for most of last week. So a little bit lower, not too terribly so. We're about 29.5% to 30% off the true peak that we achieved before the sell-off began, which is right around the average that we see for most bear markets. Most bear markets see about a 30% sell-off peak to trough. And we're right at that level right now. There's clearly a lot of fear in the marketplace. We're seeing people call for the major exchanges to shut down. We've seen calls for limiting gatherings to 10 people. We've seen some shelter-in-place orders out in San Francisco. And President Trump came out this afternoon and basically made the comment that the lingering effects of the virus may be with us for quite some time until June or July, which is really what I think sent selling pressure a lot further than the sort of down 10 that we've been in, the down 9 to 10 that we've been in for most of the day. If you think about that, that's a little odd in the context of what's going on elsewhere in the world, particularly China, where this virus has been largely contained. If you look at new virus cases in China, they are in the single digits at this point. And if you think about the economic impact of what we are doing in an effort to contain the virus in terms of shutting down large gatherings, ordering people to shelter in place, this is effective because it keeps people from transmitting the virus to one another. And so long as we're effective in shutting down that transmission rate, which we should start to see in a couple of weeks, then we should be able to bring the case number down to a reasonable level. And as the weather warms up, which is something that we've spoken about previously, we should be able to get out of the more draconian measures associated with what's going on in our economy. If you talk to some of the larger investment banks, some of the larger financial firms about their expectations for overall GDP, it's unclear whether or not we will actually get a technical recession associated with this. However, the second quarter will probably be pretty rough, particularly if we maintain travel bans and shelter-in-place type orders through the end of April and into May. That will obviously curtail a lot of economic activity. The good news is that once the virus is contained, these type of event-driven markets tend to bounce back relatively quickly, and you'll see that in the economic forecasts that are out there, whether they're from Treasury or from the major banks. You see, a contraction reasonably sharp in Q2, maybe even as much as 5%, followed by some pretty intense growth in Q3 and Q4 as we make up a little bit of that demand. So once again, this is a situation where you shouldn't be selling based on fear, no more so than you should buy based on euphoria. If you have the ability to take a look at your account and either sell off some positions due to taxes or rebalance to take advantage of lower prices, we'd encourage you to do so. If you have any questions for us or your advisor, please feel free to reach out, and I hope you have a great week. Thanks.